Welcome to BDO and to our not-for-profit accounting update. My name's Anthony Whyte. I'm one of the audit partners at BDO here, and I work a lot in the not-for-profit space. Clark Jarrold will be presenting also. So Clark's our IFRS partner here, our technical expert. So he'll be presenting as well. Before going any further, I would like to acknowledge the traditional owners of this land, and I think it's even more appropriate to do that as we lead into National Reconciliation Week. So I think it's very important that our thoughts go that way. Okay, so the numbers for this session are quite healthy. And it's not a surprise. There's a lot of changes there in the accounting standard environment that will affect not-for-profits. I know a number of you are already working through those changes, and I've had people call me, ask me various questions. I know Clark's been very busy in the space, helping organisations as well get their heads around these new standards and how to actually apply them, because it isn't necessarily straightforward. It certainly does give fodder to those that are cynical of the accounting profession, but it is the way it is, and they're the rules that we have to play by. So there is a lot changing there. These slides will be available after this presentation, and plus there'll also be a recording available after this presentation as well, if you want to go back or share it if you like it, however it works. And we will take questions throughout the presentation, so certainly don't be shy in putting up and asking a question. Clark has mentioned to me if it's too hard we may not be able to answer it, but Clark is very smart, so throw out as many questions as right. That's all right. So anyway, I'll let Clark kick it off.
Thanks, Anthony. I'll try not to be too cynical about the accounting standards today. So as I said on the slide, 2019 is going to be a big year for not-for-profit entities. 2019 and 2020, in fact, are going to be big years for not-for-profit entities. They're also big years for for-profit entities. So we've got a number of new accounting standards in the for-profit entity space. There's 3 new accounting standards that have major impact. In the not-for-profit entity space, there's 4. So in some regards, it's even harder for not-for-profit entities than for for-profit entities to deal with the new standards because you've got more. So today we're going to talk about AASB 9 financial instruments. Anthony's going to deal with AASB 15 and AASB 1058 because they're the hardest ones, so I thought it was better to give that to him. Then we'll look at AASB 16 leases. And that seems to be the standard that's getting a lot of questions. In the meetings I'm having with clients from both for-profits and not-for-profits, lots of questions about AASB 16 and somewhat less questions about AASB 15, which I find interesting because AASB 15 is probably the hardest standard actually to comply with in AASB 16, though there are a lot of difficulties in 16 when you get into it. And then we'll wrap up with some questions that you should be thinking about, such as thinking about covenants and reporting the impacts on your financial statements of these changes and making sure stakeholders are aware of these changes. So various things that we'll just cover off at the end. So just looking at a high level, the implementation dates for these new standards. You can see there AASB 9. We're applying it now for 30 June this year. If you've got a December balance date, you've already applied it. If you've got a June, you're going to be applying it June this year for the first time. We'll run through some of the things to watch out for in a few moments on AASB 9. The other 3 standards, they all impact not-for-profit entities in the next reporting period. That doesn't mean wait until next year. Because you may need to look at systems, your accounting systems, and work out now what are the impacts are going to be. So I wouldn't say just because it applies next year, forget about the 15, 16, 1058. They can have some very significant changes, so you probably should be looking at those changes now and considering the impact on financial statements, financial reporting, and what you should be saying to your stakeholders. So if we just look at B9, as I said, if your December balance date, you've already complied with the standard. So if you're June, you're about to be complying with it for the first time. A couple of key things to watch out for in terms of B9. We now have new classification and measurement categories under this standard as compared to the old standard B139. So we've been used to jargon such as available for sale financial assets, held to maturity financial assets, loans and receivables. Those categories go. We no longer have those categories in our financial statements going forward under B9. So, as a simple guide, we should be removing that sort of jargon from our financial statements. We have new categories, which you can see here, and basically we have financial assets at amortised cost, and typically that will be a trade debtors, for example. Then we have financial assets at fair value. It's either fair value through other comprehensive income, which can be for certain equity instruments or for certain debt instruments, or fair value through profit and loss, which is the residual category. So if you don't meet the tests to get into these categories, you default into fair value through profit and loss. That's the residual. So we need to reassess the categories, which category fall into, and make sure we put our financial instruments into the right category, because that category then determines the subsequent accounting. In determining what classification we're in, whether we're in amortised cost or fair value through other comprehensive income or fair value through profit and loss, the new standard B9 introduces two new tests that we have to assess. So we don't determine the category by definition, we apply these new tests to determine which category we're in. And the first test is what might be called the solely payments of principal and interest test. So you look at your cash flows and the types of cash flows that arise from the financial instrument that you have, and you assess whether or not those cash flows satisfy the solely payments of principal and interest test. That test is basically that the cash flows you're going to get are consistent with what you might term a basic lending arrangement. You get your principal back and interest back. Interest being compensation for credit risk and time value, etc. If the payments include some other factors, such as a profit element on the underlying activity, you'll typically fail that solely payments of principal and interest test. So think of ordinary shares. You invest in shares on the stock exchange. The cash flows are going to go back. They're not going to meet that test. You get an equity return there. If there's cash flows that you invest in or lend money to an entity, and the cash flows are going to get back 25% of the profits of what that entity is doing, that's going to fail that test, typically. So we apply the solely payments of principal and interest test. If we fail it, there's other characteristics of cash flows we're going to get. We're back down into fair value through profit and loss, automatically. The one point to make there is that there is an election for equity instruments, investments in equity instruments, think of ordinary shares. There is a once-off election to account for those investments in equity instruments at fair value through other comprehensive income, rather than fair value through profit and loss. It's irrevocable, and it's one initial recognition. You make that election. If you do that, the accounting is still fairly simple. All fair value, still have to assess fair value. All fair value changes just go straight to other comprehensive income, not through profit and loss. and on ultimate disposal, they stay in other comprehensive income. You don't recycle to profit and loss like you used to do with available sale instruments under the old standard. So the accounting is somewhat simpler. Dividends go to profit and loss. So that's equity instruments. And if you fail the solid payments of principal interest test. If you meet that test, then you've still got to consider the business models test. Now that's a test where you consider the characteristics of your business model for those financial instruments. What is your business model? Is it to hold those financial instruments to collect the cash flows, and that's it? Or is your business model to collect the cash flows and also sell? Now that's not to say that you may never sell the ones in hold to collect. You may sell some occasionally, but you still meet that test, the hold to collect test. Now, if you meet hold to collect cash flows from the instrument, think of trade debtors. Typically, you got your trade debtor, you just collect them. You'll account for the instrument at amortised cost, and that's the simplest account. Of course, you don't have to assess fair value. If you don't meet the hold to collect test, and you meet the hold to collect and sell test, and that might apply to, say, government bonds. So I invest in government bonds, I hold them, sometimes I'll sell them, sometimes I just hold them, collect the cash flows. I've got a mixed model. Then I can't say I meet the hold to collect test. Government bonds, I'll meet the solid payments of principal and interest test because I'm just getting principal and interest on the bonds, and I meet the hold to collect and sell. I'll count for them at fair value through other comprehensive income. Now, if you're doing that for debt instruments, it's not as simple as equity instrument accounting at fair value through other comprehensive income. It is more complex than that. You still need to consider for debt instruments at fair value through other comprehensive income, impairment, and still recognise impairment losses in profit and loss. And there is recycling. So for those sorts of instruments, it is still quite complex, the accounting under that model. And then if you fail that, or don't meet that business model test, you're just in other, which might be just to sell. That's your model, it's just to sell. Your fair value through profit and loss. So that's a significant change to the old standard. We have to assess these two new tests, and that drives the accounting.
But can I just, before we jump off that, so where I've seen this come into play for not-for-profits, and it really does have an impact on some not-for-profits, where they have significant investments. So a lot of the larger not-for-profits do put money away and have investments as part of their strategy of their long-term objectives. So, and often those investments are a mixture. They might be shares that are directly held, they might be managed funds that are in shares, they might be corporate bonds, and they might be bank deposits. You can effectively have, within those classifications, 3 lots of classifications: at amortised cost, at fair value through other comprehensive income, at fair value through the P&L. So it does get quite complicated, becomes quite complicated for the users when they're looking at that and seeing all those different classifications. One important thing to keep in mind is the managed funds that, say, might just be in shares. That I don't think necessarily.
Well, we've actually got that point here as the first point to make on this slide, so I'll just continue on that point. What Anthony's getting at, and an issue we have come across, is that for some entities that adopted the standard early, is that they were electing to account for what they thought were equity instruments at fair value through other comprehensive income, and under the election available, rather than at fair value through profit and loss. What's come out is, as a result of some decisions that were made internationally at what's called the IFRIC, it's been determined that if an instrument doesn't meet the definition of equity in the relevant accounting standard AASB 132 or the international standard equivalent, if it doesn't meet the definition of equity from the perspective of the issuer of the instrument, then it is not an equity instrument for the purpose of the election to be accounted for at fair value through other comprehensive income. So that's under that election. So you don't get the simple accounting if that's the case. So you need to be careful in applying that election, in other words, of treating equity instruments at fair value through other comprehensive income. That's the key message. Be very careful in applying that election. Make sure the instrument you're accounting for is actually an equity instrument as defined.
For organisations that have been addressing this, one of the principles that they've generally applied is to keep it simple. So follow an approach that keeps it relatively simple and understandable. So they might hold shares directly and still have the managed funds, but rather than make the decision, run those shares at fair value through other comprehensive income, they run that through the P&L as well because it just simplifies the accounting.
When you mention managed funds, typically investments in managed funds are investments in trusts. I'd be very careful in assessing that the investment I hold is an equity instrument. Because if you've got an investment in trust, I would think the default position would be that it fails the definition of equity. That would be the default. There may be some instances where it would. But I'd be applying the default position is it would fail the definition of equity. And the reason for that is most trusts have a limited life, or the instruments are puttable. The trust, you can put it back in the trust, so in which case they would fail the core definition of equity. Don't look at merely how they classify the financial statements, because even though they may show as equity, it doesn't mean it actually meets the definition of equity. It's a trap there if you're not careful. So any investment in a managed fund, be very careful in saying that investment meets the definition of equity instrument, therefore accounted for at fair value through other comprehensive income. It may be that it should be accounted for at fair value through profit and loss, and you don't really have the election. That's the point. And we've seen some instances where entities have treated it under the election through other comprehensive income, and that's not correct because of that decision by the IFREC in late 2017. So that's something to watch out for in not-for-profit space. Because of the portfolios, as Anthony mentioned, that not-for-profits have portfolio investments. Another thing to watch out for is impairment of financial assets. We have quite a different impairment model under this standard as compared to the old impairment model under the old standard. We have what's now referred to as an expected credit loss model rather than an incurred loss model. So what that means is that you don't need an impairment trigger to have to recognise an impairment provision for receivable, say for trade receivables or for loans. So it's a far more complex model, the expected credit loss model, as compared to the model we've been used to under AASB 139, the incurred loss model. We have to look at things like significant increase in credit risk. We have to assess the credit risk of the counterparty to the instrument and assess whether there's been any significant increase in credit risk. That drives the calculation of the expected credit loss. They're things we haven't had to worry about in the past, which are new. A credit loss, the standard tells us what a credit loss is, and that's the difference between the contractual cash flows on the instrument and the expected cash flows. So a credit loss can arise because you're not going to get all the cash flows back that you expect, or they're going to come back, but they're going to come back later. So remember, time value of money can give rise to a credit loss event if the cash flows are later. We can use certain practical expedients in measuring the expected credit loss, particularly in trade receivables. So the standard actually gives an example of a provision matrix, which many of you would be used to. a simple example of a provision matrix is ageing for your receivables and applying loss provisions by aging category against the amount that's receivable under that aging as at the reporting date. So what you would do is you would look at the level of aging, you look at the historical loss rates for each aging category, and then based on those historical loss rates, you look at what any current or future expectations that would change those historical rates that you've had, whether you should amend them, and then apply those rates against the amount of receivables at the reporting date, and that'll give you your expected credit loss provision. So there are some practical expedients in the standard you can apply. But if you've got loans to third parties, you've got to use and think through the full impairment loss requirements and assess what is the risk of default on the loan. You may have to assess cash flows given the default and what the loss is going to be to actually calculate your expected credit losses. There's some further information on that in some of our webinars, so we're not going to go into any further detail on that. We don't have time tonight to go into that, but there's some further information in our webinars that will help you understand that expected credit loss model. I'll hand over to Anthony.
I'll just add in relation to that expected credit loss that Clark was talking about. So say for groups with inter-entity loans, and you need to prepare separate accounts for the entities within the group, it becomes a bit of an issue as well in relation to those inter-entity loans. I'm thinking of one group I opt for in particular, quite a large group, and they do produce separate accounts for the different entities in it, so they'll need to be looking at that and looking at how they assess expected credit loss. Okay, the new revenue standards. So I get the juicy one. So we'll jump straight into it. You'll be glad to know that mine is full of decision trees and examples, so it might be a bit easier to absorb in. But as I said before, feel free to ask questions as we go. So some of you might be wondering, well, how do I know whether I fall within AASB 15 to recognise revenue, or if I fall under AASB 1058? So there's quite this simple decision tree which we can work through to help work that out. So the first question in it, the funds that you receive for the purpose of acquiring or constructing a non-financial asset. If the answer to that is yes, then it's likely we're going to fall within 1058, and we'll be talking about that a bit later. But if that's not what the funds are received for, does the transaction occur in a contract with a customer that created enforceable rights and obligations? If the answer to that is yes, then does the contract include sufficiently specific performance obligations, i.e. promises by the not-for-profit to transfer goods and services or services to a customer? If the answer to that is yes, then you're within AASB 15. And this is where, for not-for-profits, that understanding of what's meant by sufficiently specific performance obligations, that's where the struggle is, I think, and that's where a lot of judgment is involved. So we'll be talking around that a bit. So the key points in that are, to be in 15, you have to have a contract with the customer. Now that customer could be the government. You might be delivering services to the underprivileged or whatever, and the government's providing the money, but that's still a contract with the customer, and you must be able to identify the performance obligations and when they're satisfied. So that's basically what we're going to be working through to start with. Now within AASB 15, recognising revenue basically now comes down to a 5-step process. So the first step is to identify the contract with the customer. Second step is to identify the separate performance obligations under that contract. And this is where it might start to get a little bit difficult for not-for-profits. The third step is to determine the transaction price. The fourth step then is to allocate the transaction price across the performance obligations, and then the final step is to recognise revenue when those performance obligations are satisfied. Now, if the contract we're looking at, and I keep referring back, say, to a grant, if that all occurs within 1 year and the grant runs for your financial year and it's all wrapped up within a financial year, this is less of an issue. But if you've got longer term contracts or arrangements that run over a reporting date, this becomes more relevant. You need to work through these processes in relation to those transactions. I will say too, it's just not grants that we're talking about. I know there are not-for-profits here that might provide employment services. They get a fee up front when they take someone on, and then they've probably got a few years to see that person through employment, and they'll get fees along the way. That's caught up in this as well, and you need to break it down and identify your performance obligations and determine when they're met and determine transaction prices. So there's a bit of a process to work through. Okay, so one of the key things as you're picking up is to determine, well, what is a performance obligation? So a performance obligation is a promise to a customer to transfer to the customer a good or service that is distinct, or a series of good or services that are substantially the same, have the same pattern of transfer. But if we just keep it simple, if we think of a good or service that is distinct, that's a performance obligation. And we'll be going through an example to help solidify that understanding. Okay, so what does distinct mean? So this diagram kind of, again, goes through a bit of a process of working out whether something is distinct, a performance obligation is distinct. So if the customer can benefit from the good or service either on its own or with other readily available resources, then we're heading down the path of that performance obligation being distinct. If the promise to transfer the good or service is separate from other promised goods or services in the contract, then it's distinct. Okay, so if it can be separated out, it's distinct. Now, I won't necessarily go through these different elements that might suggest it's not distinct.
I'd just say, Anthony, this area is probably one of the hardest areas in applying the new standard AASB 15, determining whether the goods and services are separately identifiable or not. That's becoming a real problem area and judgmental area in applying the standard.
So if we jump into an example, you'll see why this is a judgmental area, and some of you might jump to different conclusions on this as to how to treat this initial $1,000 joining fee. So here we're looking at Entity G. It operates a gym for its members. To become a member, the customer must pay a one-off upfront joining fee of $1,000 and then its annual subscription fee. The joining fee entitles the customer to renew the contract, i.e. it's an option to acquire gym services in the future by paying the annual subscriptions but without paying any further joining fee. So Entity G assesses whether the joining fee relates to the transfer of a promise, good or service on inception of the customer's membership and concludes that it doesn't. Okay, instead the joining fee is an advanced payment for future gym services. So they've handed over their $1,000 as their joining fee. Really, they've received nothing for that. There's no distinct good or service that they've received in return for that.
At that time.
At that point in time, that's exactly right. Really, it's given them a right to continue an annual membership of that gym by paying that annual membership fee and without paying any further upfront fees. So I won't read through this, but at the end of the day, it talks about, well, in determining the accounting, do we spread it over the first year, or do we spread it, that $1,000 over the time we expect this person to be using the gym for, and it falls out, spread it over the time you expect the person to be using the gym for. Now, under current accounting standards, I'd imagine a lot would actually recognise that $1,000 when they've received it, potentially. But now when we're trying to break it down to say what are the performance obligations that attach to that, and are they distinct goods or services that are delivered, well, when you initially pay that $1,000 joining fee, at that time, there is nothing delivered to the customer. Okay, so it does cause us to look at this in a different way, and I can see Lindsay's really thinking about that quite hard. It does take some thinking, you're right. Okay, so now in the time that we've got, we can only cover so much. We can only cover those 5 steps so much. So I just want to draw your attention, there are a number of webinars that are coming up and that have already occurred that go through AASB 15. February we already had one looking at the practical issues, and in April there was one go up around the practical issues at 1058. That is in a lot of ways similar to what we're talking about tonight. And then future ones coming up are looking at disclosure issues around it, and then the lessons learned from the application of these standards. So certainly watch out for those. If you want to go back and unpack those steps a bit more and look in more detail around the performance obligations, identifying those, allocating transaction price and so on, then there's numerous webinars that are up on our website that go over that as well. So they're all about an hour in length. So there is a lot of information there. Okay, but to be honest, the best way to understand this sometimes is to work through some examples. So that's what we'll do now. So in this particular example, on 30 June 2020, an alumnus transferred $2 million to University A as an endowment. The terms were the $2 million to be invested at the university's discretion. University A is required to provide an annual scholarship for one student's accommodation for a period of 30 years. And the expected cost is $1,850,000. Now, when you read that, do you think, is that one student that's there for 30 years? I have someone living in my household that has been a student for 30 years. I'm sure that's not what it's contemplating. If the university breaches the terms of the endowment, the university is required to return the real value of the principal. The report date's 30 June. So here we've got something that it is sufficiently specific, a performance obligation to provide one person accommodation per annum, and it's for a fixed term, it's over 30 years. So it is sufficiently specific. There is a contract in place, there's a requirement to return any unspent funds as such.
So that means it's enforceable.
Yeah.
So if you look, one of the key things to look for that makes it easy is if you see there's a return obligation, if you don't comply with it, the funds, well then it's all enforceable. So that's the simplest way. I mean, there can be other ways it can be enforceable, but in practice that's going to be the simplest way. So as soon as you see that, you can tick the enforceable test.
So the accounting is interesting. We receive the cash. We don't take the whole $2 million to unearned income or contract liability. We take the fair value of what we're expected to deliver, the cost as a contract liability. But the funds that we receive are more than the cost of what we're expected to deliver. Therefore, there's income there to recognise when we initially receive or become entitled to that $2 million. And then this is probably oversimplifying it, but then recognising each year 1/30 of that contract liability as income as it unwinds. Now, to get really technical, you argue there probably needs to be some level of discounting and whatever involved, but we won't go down that. So, nothing you wanted to add to that one? Okay, so here's another example, and this one comes up again a little bit later on. So local government enters into an agreement with the state government in the form of an MOU to receive multi-year cash grant of $90,000 from the state government, received on the 24th of June 2020. Grant is to fund education programs over 3 years, commencing 1 July 2020, with the objective of increasing literacy in a specific area. Now, this is important. The MOU outlines the agreed activities of the education program that are tailored to the literacy needs. The local government is able to identify when its specific performance obligations are satisfied and expects to fulfil the promise in relation to that. And again, the state government can enforce repayment of the grant if the specified activities are not undertaken. Okay, so the accounting probably is working out how you'd expect. So when you initially receive the money, you're recognising a liability, a contract liability. Now, the terminology here is a bit different to what we've seen before. Like previously or currently we use reference to deferred revenue. You will see in AASB 15 reference to contract assets, contract liabilities. They're going to be accounts that are going to start to hit our financial statements. And as you'd expect, that contract liability unwinds over the 3 years. So,
and the reason that that's the accounting is because it's enforceable and it's sufficient, and you meet the sufficient and specific test. So that's what we go through. Is it enforceable? That's the decision tree Anthony showed up front. Is it enforceable? Or it's repayable? Yes. And is it sufficient? Are the performance obligations sufficiently specific? Yes. We've basically given that. So therefore we drop into AASB 15 rather than AASB 1058.
So Anthony, a quick question.
Yeah.
So that contract liability, it's calculated in a similar manner to what you'd calculate unearned income.
yep.
It doesn't actually reference what it's actually going to cost you to deliver the service.
No, that's the revenue.
It's purely staying.
It's the revenue.
It stays at the revenue line.
Yeah, that's your revenue. We're accounting for revenue here.
Yeah, it's purely revenue.
Yeah. But that's a good question, Russell, because if you draw a line back to that accommodation question we had, say the grant here was very generous and was well above, and this probably isn't realistic to be honest, the grants are never really that generous, but well above the expected cost of delivering that service, then you do have an element of where what you've received is greater than the fair value of what you've expected to deliver. And as long as it's all for purpose of mission, there is an element that you would draw to income, and that's what happened in that accommodation example.
The question is the fair value the cost or something else? I would suggest the fair value may be something else.
Yeah.
Not just the cost.
Yeah. But anyway, to be honest, that's a bit unrealistic. Okay, so the transition to the new revenue standard. There's a couple of options available. One's the full retrospective approach. And before summarising that, to be honest, it's not that difficult. It probably is important to highlight that regardless of the approach you take here, the calculations, the measurement still needs to be retrospective. So for example, if you received a grant 10 years ago to buy a building, and there's requirements under that grant to return funds over the next 40 years if you change purpose or whatever, you still need to apply AASB 15 to that effectively, because that's still in your books in some way, and potentially if you've got it in there as unearned revenue, and this still needs to be applied retrospectively in the measurement of those transactions.
I would caution that there are some practical expedients in the transition requirements that you should assess, particularly around the concept of completed contracts, because for certain completed contracts you don't have to go and apply the standard date of transition. So look very, very carefully at the transition rules around completed contracts. That would be my advice. in both AASB 15 and AASB 1058.
Okay, so the options that you do have around transition, so full retrospective method, so that's basically means adjusting your comparative figures. So if you're a 30 June year end, that would mean adjusting your 30 June 19 figures to reflect as though AASB 15 had always applied, and adjusting your opening retained earnings for the 30 June 19 year. So that would be your 1 July 18 retained earnings. So that's a full retrospective approach. If you like though, you can do the cumulative effect approach, and really that means from 1 July 19, that's when it affects the numbers you're reporting in your financial statements. So you adjust your opening retained earnings at 1 July 19, and the impact on the figures for the year ending 30 June 2020, AASB 15 applies. The comparative figures you have in those 30 June 2020 accounts, they will still be measured and recognised under the old revenue standard. So basically you're not adjusting your comparatives.
There's one track to watch out for there, and that is in the disclosures and the notes, because in the disclosures and the notes, you also need to give the revenue numbers under the old standards for the first year, for June 2020 in your case, for example. So you have to run two systems almost, if you want to think about it, for the first year, to report the change numbers under the new standard in the primary statements, and report the numbers under the old standard in the notes, because there's got to be some comparability within the accounts, so they can compare that number in the 2020 year under the old standard in the notes to the amount in your comparatives, which are under the old standards, if you take that cumulative effect method. So there's some extra work there, if you take that.
Okay, probably not worth spending too much time on this slide. It just talks about what we were talking about before. So going back to that $90,000 example for improved literacy, old standards possibly recognised as revenue up front. I'd argue most organisations would have recognised that as income in advance and spread it over the 3 years anyway. Under the full retrospective approach, you can see that you adjust your 19 figures and your 20 figures, and under the cumulative approach, you're not reporting anything in the previous year, you're just adjusting your opening retained earnings for 30 June 2020. Okay, so 1058, when do we fall within 1058? So 1058 does cover receipt of volunteer services, and that you've all probably heard that. That is optional for private, not-for-profit entities. For public, not-for-profit entities, it's not necessarily optional. I think most organisations are saying too difficult to measure. The cost benefit doesn't necessarily work. Now, whether that changes down the track, ACNC is certainly on a mission to make information about not-for-profits more readily available for the public generally, and whether as part of that we start to see organisations do want to quantify their volunteer services to demonstrate how big it is to their organisation will remain to see. 1058 also covers where transactions where the consideration to acquire an asset is significantly less than the fair value, and it's principally provided to enable the not-for-profit to further its objectives. So, simple example, a donation. You acquire it, you're really providing nothing to that donor in return as such. So it falls under 1058. So going back to that decision tree that we had before, the funds received for the purpose of acquiring an asset, yes, then most likely fall under 1058. Does the transaction occur in a contract with the customer that created enforceable rights? No, then we're in 1058. So, like I was saying before, donations, bequests, there's not a contract there that results in an enforceable right, so that's why they often fall under Does the contract include sufficiently specific performance obligations? If it doesn't, then it's under 1058. Okay, and again, like I was saying before, this is where organisations are trying to work out, well, are my agreements, are the deliverables under that sufficiently specific so as to then spread the income. So we'll look at the building example to start with. So state government provides a $2 million cash grant to a private not-for-profit school to build an early learning centre on school land. Now, the school age required to construct the early learning centre as specified and retain control of it, return any unspent money, and reimburse the state government where the whole or a pro rata portion of the grant of the early learning centre ceases to be used for the specified purpose within the next 10 years. Okay, so not that uncommon a grant, to be honest. The school determines that the $2 million grant is an asset that the school acquired for consideration that's significantly less than fair value of the grant, and it's to further the objectives of the school. So basically they're being given $2 million. Accordingly, the grant's within 1058 and the control of the financial asset, hence it's the recognition of the assets within AASB 9, the recognition of the cash. Its agreement with the state government is to transfer a financial asset to enable it to construct a recognisable non-financial asset to be controlled by the school that meets the criteria set out in paragraph 15 of 1058. Therefore, in accordance with 16, the school recognises the grant initially as a liability when it obtains control of the funds, and the school recognises income as it satisfies its obligation to construct the early learning centre. Something that I'll point out here is in relation to the timing of the receipt of the money. If say on it might be in the 20th of June 2020, you were signed up to this agreement to receive that money to build this school, but you might not actually receive the money to build that school until October 2020, November 2020. What do you recognise as at 30 June 2020? And this is why the reference to AASB 9 is in there, looking at control. When do you have control over that? When do you recognise the receivable? If there's a clear agreement signed up by both parties that money will be provided, and this is when it will be provided, you would argue at 30 June 2020, you would actually recognise that. You would have a receivable and you would have a contract liability. So that's why that reference to AASB 9 is in there and is important. Okay, so the actual accounting entry, so when you we receive the cash, so you debit your cash, you can credit your obligation or your contract liability. Year one, you've spent some of the money, 1.2 million in building, so you debit your liability, the obligation, and you credit income for 1.2 million. Okay, and the rest goes to work in progress, and in the final year you spend the final 800. So within those first 2 years, you recognise that full amount as income. Now, there's still that requirement in that agreement that you have to use it for a specific purpose over the next 10 years. So you need to be thinking about a commitment note or a contingent liability note or something to capture that there is that requirement around it, but you're recognising it as income up front. Now, I know under the current accounting standards, and just based on research I've done in looking at various organisations that receive similar grants like this, there is a range of accounting treatment out there under current accounting standards. Some have taken that straight to reserves, some have taken up a liability, some have taken it to income. Okay, now it becomes a bit more clearer under 1058. Okay, so jumping back to that example we had before where there was the $90,000 provided to lift the literacy of students in a rural area and to be spent over 3 years. Now, the change in those facts, the Memorandum of Understanding does not specify activities the grant must be used for other than education program to increase literacy in a specific area. So, in that example, if there's no specific activity spelled out, it's just for a purpose to increase literacy, you'd argue that the performance obligations aren't sufficiently specific under that. How do you measure over the next 3-year period when you've delivered on that? It's easier when it says you have to deliver 10 of these programs in the first year, 12 in the next year. Okay, you can tick it off and you can measure over that. But if it's as simple as increased literacy in an area over 3 years, it's not specific enough to determine whether you've met those deliverables. So in that instance, you're under 1058, and 1058 requires you to recognise that income up front. Okay, so I think under current accounting standards, you would recognise it as income and advancement, not looking at sufficiently specific. No, we're just meant to deliver this over 3 years, but under 1058, we now recognise that income up front.
Anthony, do you want to just comment on the cash element? Most of these grants have you might get paid every 3 months, or every 6 months, whatever, over the 3-year period. Will that impact the journal?
It potentially does. It goes back to looking at whether you've got this enforceable right under it. Often, if you receive the next instalment in 6 months, you actually have to be reporting on where you got to and provide certain deliverables before you then get that next instalment. So when it's like that, I would suggest that you probably find that you're not recognising the full amount up front, the receivable or whatever, because there is an element of uncertainty around you'll get it due to future activities. So, imagine Clark, I got that one right. Okay, so that's good.
I mean, my comment on all that would be that the idea of sufficient and specific test is that you can determine when your performance obligations are satisfied. When you putting that into practice and you looking at the examples in the standards WSB 1058 and WSB 15, it's not easy working out what the WSB really wants you to do. Unfortunately, it's not really clear. I mean, sure, it's clear that if you tick sufficiently specific, you're 15 as long as it's enforceable, and if it's not sufficiently specific, you're 1058. But what's not clear is whether, in a particular set of circumstances, often it's not clear as it's sufficiently specific, and you get different decisions by different people. So we're going to still see diversity in practice in many cases there, because that lack of clarity.
Let's ask the question. So if a grant is not in line with the financial year, so it's still got 6 months to go, so do we recognise, do we have to, is it likely that the cost of the grant, of providing the cost, is different to the amount of revenue that we recognise? So at the moment, most people sort of draw the grant down as they use the funds. Is this likely to give us an instance where we've got to say, well, we've only achieved 25% of the objectives to date, even though we spent maybe 50% of the money as a start-up or whatever? So,
yeah, absolutely, because you remember when we had those 5 steps up there. One's to add, I think step 4 was to allocate the transaction price across the deliverables. So your deliverables might be those steps within the grant that you're required to deliver. Now, you might have spent 50% of that money just on 25% of those steps. So it might be that, you're only recognising 25% of the income at that reporting date. And then hopefully you deliver the remaining 75% pay. So there is a bit of a mismatch there between your costs and your activity. It is driven off the delivery of the activity.
Agreed. So costs and the occurrence of cost doesn't drive the accounting for the income. So the simplest example is if you're in 1058, because you can't get into 15, you recognise the income upfront. You only get deferral if you, setting aside the example Anthony went through with the construction of a recognisable non-financial asset, a building. Setting that aside, if you're in 1058, you recognise the income upfront. You get deferral if you get into AASB 15, so I should say you can get deferral if you get into AASB 15. But it's not the cost that drives the recognition of the income. It's what standard you're in, and then it's satisfaction of your performance obligations. I think that's what essentially Anthony was saying.
Anthony, that example that you had of having to improve literacy.
Yep.
The accounting treatment suggesting that you need to do nothing in order to earn the income. You don't need to do a single thing. But the reality is probably that if you do nothing, that the grantor would say you didn't do a thing.
Yep.
Get the money back.
Yeah.
Yeah. Well, the standards deal with that, and you have the choice of doing something or not doing anything. But you don't have a liability just because you haven't yet done anything. Because you may not have to start until 1 July the next year or something like that. It's only when you breach the arrangement then you might have to book a liability. So the standards do deal with that. It's your choice to comply or not when you receive it. And if you breach it, then you might have to book a liability.
So if you want to defer, I think most organisations would want to defer income, not bring income to account at the front end.
Well, match the income.
Yeah, you want to get into AASB 15.
Yeah, but you want to potentially talk to your grant providers about making the agreements, having specific hurdles in the agreements over a period of time, and then potentially then try and defer the income. Is that
you could do that. I mean, by getting sufficiently specific performance obligations in the arrangement, of course, that might change the risk between the parties as well.
Sure.
So there's a pro and a con there from the perspective of the not-for-profit entity.
I know there are a number of people here that have started looking at this and looking at their agreements, and I know if I ask the question of has anyone sort of come up with contracts where they don't think there's sufficient specific obligations, no one's going to stick their hand up because that's the way it happens in these situations. But I know from the clients I've worked on and looking at the contracts, the grants that are in place, often there's appendices attached to it and specific things spelled out that need to be achieved by a certain time and whatever, and those activities have to be reported on every 6 months and whatever. So maybe it'll work out that organisations will be able to identify those obligations and identify that they are sufficiently specific. But really, what all organisations need to be doing now is looking at those agreements and just making sure that they are across that they're documenting that for each of their agreements. It's just not a matter of looking at one, you've got to look at all your agreements.
Yeah, that's a good point, Anthony. We've done a few exercises for not-for-profit clients, and it is getting down to the individual agreement and assessing the individual agreement and what's the requirements in that agreement. That's how detailed you've got to get on these, under these new standards. Looking at the individual contract. You can't just say, all these grants are accounted for this way. It doesn't work like that anymore.
How would that affect the cooperative? As a startup cooperative?
Well, I suppose the nature of the entity doesn't change anything in any way, so whether it's a cooperative association or whatever.
Well, it's affordable housing.
Yeah.
As a cooperative.
Yeah.
With local employment.
Yeah.
You have to look at the contracts that you have and go through the specifics of those contracts to determine the accounting.
Yeah. So we are having drinks at the end of this, and some of us who do drink probably need a drink. So Parker and I will be around, and plus there's some others from BDO around. So certainly if there are specific questions that you want to put to about this pain situations, we'd be happy to talk to you about those. But anyway, so we've got about 20 minutes left. Do leases.
hopefully you can hear me up the back. So we're going to look at AASB 16 leases, and as I said up front, this is the standard we seem to be getting all the questions about, interestingly. But what Anthony just gone through, AASB 15, AASB 1058, we started to see some of the questions there. There is a lot in those standards as we're finding as we're going on. So, AASB 16, the big news, and you've probably heard this in the past, or you're probably aware of it, we no longer, for lessees, have operating leases. What we have had operating leases in the past, they've been off balance sheet. Going forward, they're on balance sheet. That's the big message. So no longer will you be trying to work out, is this an operating lease or a finance lease, therefore get off balance sheet or off balance sheet. That sort of decision making is no longer relevant for lessees. Interestingly, for lessors, they still have to assess whether you have an operating lease or a finance lease from their perspective, because that drives the accounting for lessors still, but not for lessees. Under AASB 16, just to put it simply, from a lessee's perspective, we've got a single model, all leases are on balance sheet. There's a couple of exceptions which I'll touch on in a few slides. They'll be accounted for similar to finance leases in the past, but not exactly the same. Because if you think about finance leases in the past, you've got a finance lease for a motor vehicle, etc. Typically, you don't have option periods and you don't have variable payments under those finance leases. Payments are fixed typically over the lease term. But with the new standard, it deals with variable payments, such as payments changing because of CPI or market reviews. It also deals with option periods. The old finance leases, part of the old standard AASB 117, didn't really go into that in any detail. So it's a bit different and a bit more complex than just simply saying, I've heard one of my colleagues say, it's just treat operating leases as finance leases. It's a bit more complex than that. So the main changes in practice for lessees, as I said, no more operating leases. As a result, the expense profile changes. Because if you think about it, you recognise the asset and liability on balance sheet, you might still have, in the past we straight lined the rental expense, there's still a straight line typically of the depreciation of the right of use asset, but the interest expense declines over time. So early on it's higher because the liability is higher, and as the liability declines, the interest expense declines. So the profile of expenses changes. There's front loading of expense and less expense in the latter part of the life because there's lower interest. As I said, we have a right of use asset and lease liability. In determining the right of use asset and the lease liability, the question is what payments and for what period you have to take into account to calculate the numbers. So what the standard tells us is we have to include fixed lease payments, and what it refers to as in substance fixed lease payments. We include index-linked payments and payments subject to, say, market reviews, but the timing of those is something that you should be aware of. You don't try and estimate up front what the CPI changes will be over the period of the lease. You account for up front the lease liability and the right of use asset based on the payments you start with, and you only adjust for CPI changes or market rent review changes in the future when they occur. Typically, the adjustment to the right of use asset and lease liability at that date in the future when the change occurs. I mentioned option periods. The standard deals with option periods, and the lease term obviously determines or affects the quantum of the right of use asset and the lease liability. The longer the lease term, the higher on initial recognition the lease liability and the right of use asset, obviously. So some people might be thinking we want to try and reduce the lease term, so we'll enter into a series of leases with short terms and a whole bunch of option periods. Well, what the standard says is that you have to include in the lease term those option periods that you're reasonably certain to exercise. And you take into account economic incentives in making that decision. So, a simple example. You go into a building, you put in fit out for 10 years, fit out that'll last 10 years, it's cost you a couple $1 million. And then you say, oh, we'll have a lease period initially of 2 years, and I'll have 4 lots of options of 2 years each. Do you have an economic incentive, do you think, to exercise those option periods if your leasehold improvements are going to last 10 years and it costs you that much money? I would suggest you do have an economic incentive. So the lease term probably has to be assessed at 10 years. You need to consider other factors too, obviously, but that's just a simple example. There's going to be significant changes on lessees' financial statements, key ratios, etc. So obviously I've mentioned the front loading of expense, so that could impact profits, they'll be lower, everything else being equal in the earlier years. EBITDA changes because no longer do you have an operating lease rental expense in EBITDA, you have depreciation and interest down below the EBITDA line. The balance sheet ratios obviously change. For some entities, bank covenants will have to be assessed because your balance sheet ratios change or your EBITDA changes. And if you've got borrowings to the bank and they have covenants in there based on financial ratios, you might find that the changes in the financial ratios impact your compliance with your covenants. So you might be wanting to talk to your bank if that's going to be the case. For companies that pay dividends, and it's probably not relevant in the not-for-profit space, but for companies that pay dividends, this can affect the ability to pay dividends. It can also affect other contracts where financial ratios are important, such as performance bonuses and such like. So all those things could be impacted by this change. We'll just move to a simplified example, show you so you can see what the impact of this is going to be like on this an entity with this side of the example. Just a building lease, nice simple example to use. So we've got a 3-year lease of a building with the rental payments as shown there, and we're told in this example the entity's incremental borrowing rate. So just a point to note is that under the standard, in the first instance you're supposed to use the interest rate implicit in the lease. In many cases you're not going to be able to determine that, particularly if you're leasing a building. So you're going to default to the incremental borrowing rate, which is the alternative that the standard allows. So you have to determine the lessee's incremental borrowing rate because the lease liability is calculated at the present value of the future payments. Under the old standard, we would have said this is going to be an operating lease. You haven't transferred substantial risk rewards of ownership. So it's an operating lease, so you'll just straight line the rental expense over the 3 years. Nice and simple. So you calculate the total quantum that you're going to pay over the 3 years, divided by 3 because it's 3 years, and you get the annual expense. Under the new standard, of course, you recognise a right of use asset and a lease liability. So I'm not going in now, given time, we're not going to go into the actual calculation, but I believe these numbers are correct. I haven't ordered them, but hopefully they are. So you can see there the difference between the old standard and the new standard. So under the old standard, we have an expense of $72,000 a year, and that'll be an operating lease expense, and as I said, that'll be up in the EBITDA, above the EBITDA line. Under the new standard, we'll have interest expense, which declines over the years, 14, 11 and 4, as the liability goes down. And we'll have amortisation expense of, in this example, $61,000, which will be the same each year. So overall, the expenses, as you can see there, under the new standard, start off at $77,000 and then decline to be $66,000 in year 3. So that's just an example of how the profile of expenses will change, and therefore you can think about it, your profit, nothing else really changes in business, just a change in accounting will impact your bottom line and the profile of profit and loss. The big area where this standard has an impact is the balance sheet. Of course, under the current AASB 117 for operating leases, there is nothing on the balance sheet. That's why a lot of people historically were trying to get operating lease classification because it's straight line expense and there was no effect on the balance sheet. So you couldn't see the, you could see all the assets, all the gearing, etc. that all changes. So under this new standard, you can see there you'll have a right of use asset in this example of 123,000 at the end of year 1, 61,000 at the end of year 2, and then it becomes 0 at the end. And now have non-current liabilities, 79,000 at the end of year 1, declining, but you also have current liabilities. No current assets, but you have current liabilities, so your current liabilities or current ratio is going to looks a lot worse here as well. So you've got current liabilities, and in fact you can see here in this example the impact is negative on net assets. So a significant impact on your balance sheet. So if you think about entities with lots of leases, this is going to have a big impact. It also impacts your statement of cash flows. You might think, oh, the cash flows don't change. Well, in total they don't, but where the cash flows are shown in your statement of cash flows does change, because your operating cash flows are going to look better, because you take out the actual payments of the rental, they go out of operating cash flows, and the only thing you might include in operating cash flows under this is the finance cost or the interest element, because you've got a choice whether you put that into operating cash flows or into financing. The bulk of the payments will be repayments of principal. That'll be shown as a financing cash flow. Think of the payment of debt. So your operating cash flow will look better. And in for-profit entities, a lot of them use operating cash flow as a particularly important benchmark. So just a change in accounting standard here impacts that. I did say there's some exceptions. There's two exceptions. There's the low value item exception, which is say assets when new are less than $5,000. Now that you won't find that number in the standard. It's buried up in what's called the basis for conclusions to the standard. But all it's saying is the International Accounting Standards Board, when they made the standard, that's what they were thinking of as a value for what is a low value item. But the standard does tell us it's the value of the item when new. So if you lease a second-hand car and the value is less than 5,000 US, you don't consider that value. You consider the value of the car when new, which will be above that, so you can't use the exception. And you can apply that that exception on a lease by lease. In other words, an asset by asset basis. So if you've got a lease of 10 laptops, you could still apply it because each laptop would satisfy the low value exception. And the standard gives examples of low value items, laptops, small items of furniture and such like, phones.
How about when you've got a contract with HP for 50 laptops?
Probably okay, as long as the laptops are less than 5,000 US in value, which is probably right. Sometimes you get very expensive ones, but most of them are not above that. In other words, be okay.
You can't separate a fit out for that rule and that rule.
Yeah. Actually, that's a very good point. That's a really good point. The standard does have anti-avoidance measures, so that you can't apply that. So you've used the walls. I use a car. You can't lease the engines, the gearbox, the seats, the chassis, whatever. You can't lease all the individual components. It has an anti-avoidance measure where you have to consider all that together. The other exception is the short-term leases exception. So that's leases of 12 months or less, including option periods. So I'd be looking very closely, under this new standard when you've got to apply it, I'd be looking very closely at your leases to see if you can apply those exceptions. So you don't have to recognise the right of use asset and the lease liability. You might say, well, that's the accounting. If that's the case, well, you just apply the old accounting for that straight line. Some good news tonight, if you are not aware of this. So originally when AASB 1058 came out, one of the things that got a lot of people going about that standard was the impact of that standard on peppercorn leases. I lease a sporting oval for $1 a year from the council. So under the original AASB 1058 and examples to that standard, which example we have in these slides, it showed that you ended up recognising for the sporting field where you might pay $100 a year, you might recognise a right of use asset for $360,000, a lease liability of $1,500, and a income of $358,000. Because you had, under the original AASB 1058 requirements, you had to recognise the right of use asset at fair value, and then depreciate it. And so that got a lot of people going when this requirement first came out, because how do you determine fair value for these assets? They often have very restrictive use. You can only use it, the football field which you rent from the council, you can only use it for training and playing football. You can't use it for anything else, you can't sell it. So how do you determine the fair value of the right of use asset? Quite difficult. We in fact, with Mike, met with some property values on this very point and explored that problem, and it was really a problem, wasn't it, Mike, with those property values? They identified all those problems. So what happened late last year, the AASB, this is only an Australian problem by the way, AASB 1058 is not driven internationally, it's just Australian. So late last year the AASB issued an amending standard temporarily giving us relief from the requirement to apply the fair value for the rights of use assets on peppercorn leases. So in that journal entry, you would go back to just recognising a right of use asset for $1,537 and matching liability. In other words, you just apply the cost. You're not revaluing up effectively for the fair value of the right of use asset. They tell us it's temporary until there's guidance on how you measure the fair value. So we'll see how long that temporary measure is there for, because I'm sure lots of not-for-profit entities would like to see it there for a long time, a very long temporary relief. I can't tell you how long it'll be. So that's what that slide's commenting on as well. The other thing to mention on AASB 16 is similar to Anthony, if there are transition requirements under this standard, there are choices to make. And the choices again are the full retrospective approach or the modified retrospective approach, similar to AASB 15. Under the full retrospective approach, you're changing comparatives and everything all the way back as if you've always applied the standard. Under the modified approach, you don't change your comparatives, you just adjust. So if you're now applying this in June 2020 for the first time, you adjust the opening retained earnings for that year and you don't change the comparatives. Under this standard though, within the modified approaches, there's two further approaches. And one is a very simple approach, and that's the modified approach number 1. And under that approach, you calculate your lease liability based on the future payments at the relevant discount rate on the date of initial application. You calculate the liability, and you book it, you book the right of use asset to the same amount. So one calculation for each lease. And then you just adjust it for any accrued or prepaid element that you've accounted for under AASB 117 for that particular lease. And there's no impact on opening retained earnings. The modified approach number 2, you actually calculate your lease liability the same way as modified approach number 1, but you calculate your right of use asset on a retrospective basis, similar to as if you've always applied the standard. There's a couple of twists, but that's what you do in effect. So a similar amount of work to the full retrospective approach here. So you might say, oh, we're all going to apply this approach because it's nice and simple. Who would do that? Most of you? I would have thought most of you would, except there's a trap. Now this may not be so important to not-for-profits, but some of you would potentially be important too. certainly for for-profit entities, I'd suggest it would be very important. So under the modified approach number 1, the asset equals the liability in effect. Under this approach, the asset and liability are going to be different, and typically the asset will be significantly less than the liability. You might say, well, what does that matter? The higher the asset, the more amortisation or depreciation in the future from the date of initial application. The lower the profits in the future, and that's permanent. So some entities are not going to want to apply that approach there because it means less profits in the future as compared to this approach. So even though this takes more work, some entities will take this approach. Does that make sense? Because you get, and if you want to think of it in journal entries, under this approach you get a big debit to opening retained earnings, whereas you don't under this approach. So if you've got a bigger debit in opening retained earnings on day 1, there's lower debits to P&L in the future. If you want to think in journal entry sense. So that's why, as I said, some entities will take this approach even though it takes more work. Each entity's got to make their own determination of what's the best approach in their circumstances.
And all leases have to be dealt with under the same methodology? So
You've
got to do them all under one or
no, you might get, I'm not sure about that. So if anyone wants to come back on that, that may not be the case. So I think you can apply, I think you might be able to apply that to some and that to others.
I thought you could swap.
Yeah, I think you're right. Yeah. And that I'll hand over to Anthony just to finish off.
Thanks, Bob. Okay, so I won't go through these. It's just 2 slides of directors to be asking their CFOs, whatnot, around this. Something BDO developed in conjunction with the AASB, and it's up on the AASB website. So chances are your directors might actually be looking at some of these. So I certainly encourage you, as I said before, you'll get a copy of this presentation. Encourage you to go and just work your way through these. But it is all pretty common sense. I think at the end of the day they're going to be asking, have you assessed this yet? Have you documented it? Have you actually looked at the contracts and talked to the auditors? So that's pretty straightforward. Okay, so certainly happy to take any more questions if you want to ask questions now. There is food and drinks out to the foyer, so we will be heading out there, and if you just want to talk to us on a one-on-one basis, more than happy to do that as well. But certainly thanks for coming along. I hope it was worth your effort coming in here. You go out a bit more informed than what you came in. You will be getting a survey from us tomorrow, and we certainly appreciate the feedback that you do give on these. So if you do have the time, please do that. And I think Kate, the one that's running around organising a lot of things, will be out there if you have parked downstairs and you want your ticket validated to get a bit off the price of that. So but thanks for coming tonight, and we might head out and have a drink and a bite to eat.
Such a good idea.